So the purpose of today's call is we're going to show you how a policy works and how it gets put together. Starting off, I'll say that we work with several different companies. We do have kind of our favorites at the moment, and so we're going to use a software for one of the companies that we work with that seems to be one of our favorites at the moment. And just know that either way, the policies are going to be set up pretty similarly, even if it's with a different company. And so being able to understand the premise of how this works and why it works is kind of the main point of today. Those of you who already have policies, this should be a good refresher. I had my policy with my dad. I started my first one back in 2002 or 2003. And I feel like every year I was like, Dad, remind me what this paid up edition thing is again, and what does that do? So hopefully this will be good content for those of you who have already heard this before to just be a refresher. And those of you who are new to joining us, then this should give you an idea of, first of all, why we do the policies that we do, how they get put together, and how they give you tax-free income. So that's kind of the main goal of today. If we have time, then we're going to show you how to also use it to take loans and to kind of recycle money and allow the money to continue to compound and grow, even though you're taking it and using it as a loan to, maybe pay off a debt faster or using it for an opportunity that comes up. So there's different uses there. Okay, first and foremost, one of the questions that we get a lot is, why do we use the policies that we use, and what are the different life insurance policies? So first of all, whenever you're doing anything with money, you're always asking yourself, okay, what am I putting in versus what am I getting in exchange? And my dad has a good saying that is basically to say, okay, it's not necessarily a matter of how much do you accumulate, but how much can you actually spend? And so there's two main ways that you're looking at making money and accumulating things. And that's a little bit oversimplified, but it still helps to kind of put things into kind of two different categories. You're either taking the risk route, which would be like market accounts, for example, and there's volatility that goes with that. And usually there's going to be more up years than there's down years. So if you took a 25-year history of a market, then usually you might have about 20 years that are up positive years, and you might have about 5 that are down years. Now, nobody knows what the future of the markets are going to be, but that's a pretty good historical average if you use that as a rule of thumb. There's something called a sequence of risk return, which basically says if you've got all these highs and all these lows, and you might have 30% increase, and you might have 0 years, and you might have a 32% decrease. If you took the average over about a 25-year period, then you'd have an average rate of return of, let's say, 8%. Now that 8% isn't necessarily something that you have every single year. That's just taking the average between that whole 25-year time frame. Now, of that 8% that might be the average over that time frame, how much use do you have if it's in a 401k? How much access do you have? So can you access your 401k before 59 and a half without a penalty?
Nope.
Okay, so you can't access it without a penalty. Okay, you do have access to take a loan, and when you take a loan, then they limit you at 50,000, and you usually can take one loan at a time. Sometimes on occasion, depending on who the administrator is or who your employer is, sometimes you can do more than that, but that's kind of a general rule of thumb. So you're kind of taking it and you're putting it into the markets, you're having it do its thing, and you're hoping that it comes out ahead, which it should if you have a long time horizon. Now, what about if you're late to the game and you're kind of like, okay, I've got to make up for lost time? Sometimes people feel like the only way to get ahead is to take risk, and so then they take more risk, but it might actually work against you if you have a short time horizon. So the closer you get to retirement, the more you need stability. You need to be able to preserve what you have. You need more guarantees. You need more, of those kinds of things, because you can't really afford to take the highs and lows of the markets, because it might not work out in your favor because you don't have a long time horizon to have those risks and the benefits be able to balance out. And so sometimes it works out for you and sometimes it doesn't. So usually the closer you get to retirement or in retirement, you need to be taking less risk and preserving what you do have and have more of the guaranteed side. So, okay. Now, having said that, so that's one way to be able to make money, is to be able to take the risk and have the volatility of the market, and hopefully you have more ups than downs, which you should have, and that's one way to do that. The second way is the actuarial science route, which is basically to say, okay, we want a more steady path and have consistent growth. We want compound interest working in our favor, and we want it to just be consistent and going up and up and up. And that's the other way. So an example of that, by the way, is if you had your option of, if you had, let's say $300,000 and you could put it in the markets, or you could give somebody a loan and give them a mortgage on their home where you have the deed and you know that they're good payers. Okay. Now, how much does that investor make, or the mortgage company usually make on that loan? Okay. If you think about how much you pay out in interest to a loan over a 30-year period, if you were the one who was the lender, that's basically the other route, is to basically have it be something that's stable and consistent and increasing, and you're getting payments over time, and you're also limiting your risk. Now, the little trick to this and understanding is that you have us say this saying a lot, which is to think like a banker. So the more you think like a banker and treat your money like a banker does, the better off you are. So what are the banker rules? So banks and insurance companies follow the same rule. Number one, do they take risk? They take as little risk as possible because, first of all, they can't afford to take the risk. So there's kind of three R's. The rate of return is not as good. The regulators usually don't let them unless they're an investment bank. And the risk is too high. So rate of return, risk, and regulators are usually the three R's on why they don't do that. Now, the one that surprises people the most is the rate of return, because we're taught that in order to get ahead, we have to take risk. But yet banks and insurance companies, they both take as little risk as possible, and yet they still make a killing. They're two of the biggest industries out there. And so when we understand that there's different ways to do it, when we're talking about these policies, we're talking about that second way, which is the consistent, steady Eddie, being able to have consistency and having it be more spendable to us and taking that route. So now sometimes people want to do both, and that's fine. There's nothing wrong with doing both. It's just being able to understand that you don't have to take risk to get ahead. You can also take the consistent, steady Eddie route and also get ahead. And so being able to know that there's a difference helps to take the pressure off of feeling like that you have to take risk, you have to do the market accounts. If you like markets and they're working well for you and you have a long time horizon, feel free to do that. But you also might want to have some steady Eddie stability and be able to add that to your portfolio. And so that's what we're going to focus on today, is that side of things. So now the other side is that if you have a tax deferred account, which would be like a qualified plan of some sort, whether it's 401k, 457, 403b, whatever it is that yours is called, depending on if you're an employee of like a government employee or if you're private with a regular company, is usually a 401k. Now, those accounts are all tax deferred. So what you're doing is you're trading right now to say, I want a tax deduction now, and I'm going to bank on the fact that my tax bracket is going to be lower in the future. In order for your tax bracket to be lower in the future when you retire, that means you're retiring also off of less dollars when you retire. So you got to let that sink in. And those of you who are in retirement or near retirement, ask yourself if you want to take a 25% pay cut to retire. That's not usually people's definition of retirement, but yet that's the traditional financial planning that they'll tell you that that's what you need to kind of plan on. And so having said that, your tax bracket is not likely to be lower. And so you're not likely to be giving yourself a discount by taking a tax break now and then hoping that you're going to pay less in tax later. So if I asked you, which would you rather pay tax on, the seed or the crop, everyone would say, I want to pay on the seed and not the crop. Okay, that's what you're doing with a 401k, is you're deferring it till later, and then you're also giving yourself those golden handcuffs. Now, we like free money, so if you have a plan where you have free money, in other words, you've got a company match, then you want to put in what the company match is. Anything above that that you're needing to save, you might want to consider doing a policy, which we'll show you here. So now when you're taking out of a 401k, if you had $1 million and you took out and you wanted to make sure it was going to last you, 25, 30 years, you can take out about 4% of that. So $1 million gives you about $40,000 per year, and then increases about 3% with inflation every year. Now that 4% rule, they're saying that might be a little bit too high, that if you're wanting to make sure it's going to last you, people are living longer, we've got volatility in the markets, and so you need to kind of plan on somewhere between 2.8% and 3.5% is kind of the new rule of thumb. So if you're taking out 3.5% on $1 million, that's 35,000. If you're losing 20% to taxes, which is probably a low number, but if you're losing 20% to state and federal taxes, that leaves you with 27,000 spendable money to you. So when I was saying before, what are you putting in versus what are you actually able to spend? Your spendable money is what counts, not what it accumulates to. And so when it accumulates and then you're losing money to fees and you're losing money to taxes and you're losing money to markets, then what you're left with to spend is what matters. Okay. Now, in a policy, just as a spoiler alert, that same 1 million that would give you 27,000 spendable, in a policy you only need about 600,000. So you need about 40% less to give you the same spendable to you. So what that means is you're able to retire sooner, you're able to retire with more from what you have in the policy because of how it spends. So even if it does not accumulate as fast, which it's not going to, it doesn't need to make it more spendable to you. So that's why there's two different routes that you can take. You can take the risk route and give some of it to your other partners in fees and in taxes and in markets, or you go the steady Eddie route and give yourself the same kind of thing and you take the risk out of the equation, essentially. So that helps to be able to understand that there's two different ways that you can go. And again, you can mix and match and do a combination of the two of these. Just understand that you likely want to have at least this side be consistent as part of that portfolio. You can decide how much tax-free income you want in retirement. If you want all of it to be tax-free, then you would do more in policy, less on the other things, or you would have it accumulate here and then move it over to the policies later when you retire. If you're like, I'm okay with reducing my taxes, but I still want the potential upside of the markets, then you're going to do a combination. Okay. All right. Dad, anything I missed? Shane, Adam?
One thing I would say, and Christy brought this up too, is, um, if you're getting a company match with, say, a 401k, which is pretty standard, we typically recommend doing that because, like Christy said, it is free money, which can help to, alleviate the future tax burden because you can view it as some of those taxes are going to be coming from that free company money that you got throughout your working years. So, we are a fan of that. Anything above that, we talk to a lot of people that are putting in, 10 or 12% of their paycheck. You might want to reallocate that money somewhere else. So we'll kind of go into where to maybe put that money.
Yeah, perfect.
One other thing I would add too is for those of you that are older, think about this. I ran into this 3 times this week with different clients, and that is if you have money in a 401k or you roll it into an IRA, both of those are. Let's say that you have a 401k and you do a Roth conversion, or you roll it into not a Roth conversion, but you roll it into an IRA, for example, and then you die. So pick a number. Let's say that you had $100,000 in there. Let's say you had $1 million in there. It doesn't matter. But in other words, you don't get the money spent before you die, and it goes in an IRA. Guess what happens to that money? It goes to your kids. Now what happens? They get the taxes. And guess what? They're probably in a higher tax bracket. And actually, you will put them in a higher tax bracket because they have 10 years. They have to get that out within 10 years now. It used to be you could stretch it, but with a new tax law that went into effect basically a year ago, now that money has to be spent within 10 years. So guess what? You've just given that to your kids, which sounds great, except you gave them also the taxes that go with it. Now, if you'd have moved that into a life insurance policy, and think about this, if you move that into a life insurance policy and you dripped into it, let's say over a 5 or 10 year period of time, now you die, guess what? The kids get that income tax free. And guess what else? Taxes are on sale right now. And I really mean that. They're lower now than they will be in the next 3 years because those permanent changes that went in will probably change with the new administration. And, I don't want to get political, but we're going into the midterms. And typically, whoever's in office loses the midterms, which means that the Democrats are going to want to take away the tax deduction that all you rich people got. And so they'll start working on that. So right now, the taxes are on sale. And if we change administrations completely from going from the Republicans to the Democrats, they've already said they're going to raise the rates on all you rich people, and they will. So taxes are on sale right now. It's something to think about, those of you that are older.
By the way, if you think you're not one of those rich people, you probably are. So sometimes we don't think of ourselves as rich, but the tax brackets and the people that it affects, probably every single person on here is in that category. So don't think that by rich, that means that you've got to be, making millions. That's usually, anyone making, if you're a single person, anything over about $100,000 a year, you're kind of in that category. On a couple, then you're probably 250, I'm sorry, 225 for married couple, then that kind of puts you in that category. So that kind of puts it in perspective as far as like the tax implication of some of those that are projected and proposed for the future stuff too.
Well,
So
one thing too, when the wealthy get taxed, they just, it ends up going on us anyways. They increase the price of goods and services and we pay for it anyways. So
yeah,
there you go.
exactly.
Angela, you have your hand raised.
Oh yeah.
Yeah, I just have a quick question. So Jim said that in those 10 years where the disbursement of the 401k or IRA account comes out, how do you put that into a policy? Do you take out the minimum each year? Like just a brief overview would be great.
The short answer is we'd look at your taxes and try to do that in such a way that we don't put you in a higher tax bracket. But you may look at it and say, it's okay, I'd rather go into the higher tax bracket to get it out. So we typically would drip out. But it all comes down to what's happening with you tax wise. So we're going to be, and Christy likes to call it tax bracket management. In other words, when you have to remember when you did a 401k or one of the qualified plans, you took on a partner, and that partner is the one who gets to decide what the taxes are, and that's not you, it's the government. So that's who you took on as a partner. So you've got to disinherit that partner, and we want to do that as gingerly, as quickly, but as carefully as possible, so we don't put you into a higher tax bracket. But for all intents and purposes, you do have to pay the taxes. And so how are you going to do that? That's where we sit down and we'll talk to you. We'll do a strategy session to figure out what that is, what those
Well, a lot
numbers
of it
are.
is just understanding that how you leave things to your kids or your spouse. Now, if it's a spouse that inherits a 401k or qualified plan, then they're able to roll it into their own, and then they don't have that 10-year time clock. If you and your spouse both pass or you don't have somebody else that you're leaving it to, then that 10-year time clock applies for anybody other than a spouse. And so when that's the case, then you have that you have to get out in that time frame. Now, sometimes you might have required minimum distributions that have to come out, but you still, like, let's say you take the required minimum amount out for a little while, you still have to get the full amount out in that 10-year time frame. So at some point you're going to pay that tax. And so the point with that is that sometimes you want to spread out that tax risk. And what we would do is kind of see where is your current tax bracket and how much can we take out and keep you in that same tax bracket. That would likely be the amount that we would want to pull out and bring over, so that way you're controlling a little bit more of that tax risk versus having all of it be in one year, having 43% of it that you lose. So we want to try to minimize that as much as possible. And so that's something that we do tax planning on, to be able to look at what speed can you take it out and still stay as safe in your tax bracket as possible. So we don't want to lose any more money to the IRS than we need to. And so being able to do that strategically is something that we help with that too. Okay. All right, you guys, I'm going to share my screen and show you how we put this policy together. And I'm going to use, obviously a pretend situation here, but this is going to be kind of a quick version of how we put this together. So I'm going to say that we've got, now, by the way, if you happen to be in New York, we have restrictions on the different companies that we use, but they are regulated federally, these policies, as well as by state. And so I'm just going to kind of call this a valued client in Utah. That happens to be where I am. So I'm just going to leave it there by default. I'm going to use a male, and I'm going to say that we've got a 50-year-old male, and I'm going to put these numbers together. Now, just so you know, if you're female, these numbers are going to be better. If you are male, sorry, the insurance companies like females a little bit better. So the price of the insurance is going to be a little bit lower, which means that the value of the cash value is going to be a little bit higher. Now, when I say a little bit higher, there's not going to be a huge difference in these, you guys. And so I'll touch on that when I get to that point as well. Now, we use whole life insurance policies, and we only use mutual insurance companies, okay? Now, the reason why is because we have mutual insurance companies or stock companies. Now, a stock company is going to pay out the profits of the company to shareholders. We don't want to use those companies. We want to be able to participate in the dividends of the companies that we're investing in and putting our premiums with. Okay. And so
Christy,
we
can
want to
you
use mutual.
zoom in out a little bit?
Yep.
Or zoom in a little bit? I'm sorry.
I had a
Yep.
few requests for that.
Control or shift? Let's see. That might be as big as it's going to let me go.
If you hold down the control and then move your mouse wheel, that should also make it bigger or smaller.
There we go. Shane, I learn things new every day. Thank
There you
you.
go.
Okay. All right. I was doing the plus sign. It wasn't doing anything. So didn't know about the mouse wheel. Okay. So it's regulated by the state. It's regulated by the feds. Okay. Now, when we're putting into these, we only use mutual insurance companies. We also use whole life policies. Okay. So a quick rundown. There's permanent policies and you have tax protections by having your money grow in a life insurance policy. Okay, now there's universal life, index universal life, variable universal life, and whole life. Okay, those are the main ones that are permanent policies. They're intended to be permanent. They're not term policies that are locked in at a lower price for a set time frame, like a 10-year term is locked in at a lower price for 10 years, and then it gets higher and more expensive after that time frame runs out. Term insurance policies are the lowest cost for now, and then they become really, really high cost if you were to keep it into the future. Now, whole life policies are the highest cost now, but they also give us cash value that we can use. And then the way that we design a whole life policy is different than a normal whole life policy. Index universal, universal, and variable universal, those policies, instead of being able to participate in the profits of the company and getting dividend, instead they're having some sort of participation with the markets. Okay. Now, when I was saying before that there's different ways that you can get there, you can either take the volatility or you can take the straight shot. We don't want the volatility. If you're going to take the volatility, don't do it in an insurance policy. Do it in your 401k. Do it in a brokerage account. When you're tying it to an insurance policy, then the costs are guaranteed to go up, and then you also have the fees that go up as that is increasing. And so in the long term, then you start having those markets that can work against you, and you actually have the policy that reduces in value when you're in your 80s, 90s, and even sometimes into your 70s. We replace those all the time because they look good when they go through the projections because they're always projecting the best case scenario. But in real life, it doesn't perform according to best case scenario every year because we have down years in markets and we have volatility in markets. So please don't do those kind of policies. We don't do those. We can, but we choose not to because when we look at a whole life policy compared to those, it's essentially the same thing. So if I have my choice to take the steady Eddie route and to have more available to me, or I take this route and I have a maybe could be available to me, but it's going to eat itself up later on, which one do I want? I want the guarantee that's going to basically be the same number as this, and yet I don't have to take the risk over here. So that's the reason why we use whole life contracts and whole life policies, because it gives us consistency and it gives us something that is long-term and sustainable. And the longer that we have it, the more valuable it gets. Where an IUL or universal, variable universal, those tend to get less valuable over time. And we want this to be something that works for you now and works for you later, not just now, not just later. We want both the benefits of now and later. Okay. So I'm going to take somebody who's a 50-year-old male. Now, the insurance companies ask us to give our best guess as far as what we think the health rating is of the person that we're going to say is going to be insured on this policy. Now, there's three parties to a contract. You have the owner who ensures the financial aspect of how this gets used, and they use the policy and they fund the policy. Then you have the person who's insured, and if their life were to end, then that's when the death benefit gets paid out to the third, which is the beneficiary. Now, you can own a policy on yourself being the insured and then have your beneficiary that you choose. You can also have an insurable interest in somebody else, and you can be the owner that controls the financial aspect, and you can have like a spouse or a business partner or kids or somebody that you have a financial relationship with be the insured. So if you're not in good health and then you do have somebody that's insurable interest in, you can have them be the insured and then you can be the beneficiary. So for this purpose, I'm going to say that this person is going to own their policy. And just because I'm going to have the numbers be a little bit more conservative, I'm going to say that this person is a standard rating non-tobacco user. Okay. Now, I'm also going to add 3 different parts to a contract that we need to have available in here So it's kind of like having the right cookie recipe, right? So you can have the same ingredients, but different proportions, and it's going to have a different result and have better or worse cookies, right? You want fluffy or flat, whatever, however you like your cookies. Okay. We know the design that we want and the features that we want. And so my dad, having done this for, I don't know how many years, Dad, 25-ish?
Yes, okay.
Wow, somewhere, yeah, right in there.
I'm in my 25th year, yes.
Okay. So he's worked with so many different of these companies to know what's the right recipe, what's the right mix, how do we put this together in a way that is going to squeeze the most dollars out for you versus what you're putting in. Okay. So for each person, this is going to be different, but I mean, not different in the, anyway, every person with their age, their health rating, all of this is going to be slightly different, but we're going to have the same ingredients that are available in this process. Okay. Now, normally when you get a life insurance policy, you're getting it because you're having the death benefit that is intended to pay out in the future to your beneficiaries. Okay. We're doing the exact opposite when we're putting this together. We're putting this together because number one, being a life insurance policy, it gives us tax protections. So when we put money into here, we're not going to get a tax benefit for putting it into here, okay? Because the tax benefit is because they're knowing on a 401k that they're going to get more money from you later. This is not going to give you a tax benefit by your contribution into here. This is kind of like a Roth in the sense that once you put it here, we never want it to be taxed ever again. So you're paying tax on it first and putting it here to never have it taxed again after that.
Christy, let me just say something. When want to clarify just something. The tax benefit, there is a tax benefit, but you're not getting a tax deduction. The tax benefit is that it's growing tax deferred. It's going to come out tax free, and it's going to transfer tax free, which your 401ks and your qualified plans don't do that. So we're deferring the benefit, if you will. We're going to put the money in up front. It's exactly going in exactly like a Roth does, except there's no limit as to how much you can put in it, where a Roth has that limit.
Yeah. Okay. Now, normally on a life insurance policy, it's for the benefit of somebody else. This policy is going to be for your benefit, but it's also going to have a death benefit. Okay. But we're going to want to try to squeeze out the living benefits out of this, which the permanent policies have. So you have a living benefit that you're going to use, and you have a death benefit that's going to pass on, like my dad said, tax-free to your beneficiaries. So when we're putting this together, we're telling the software to solve for us. Instead of giving it a death benefit number, we're going to say, tell me the minimum number of death benefit that I need to have in order for this to not become a modified endowment contract, which basically is short term for, or short code for not taxable. So this is going to say, okay, the IRS says, hey, I don't care how much you want to put into these policies and into this contract. As long as you have more death benefit than you have cash value or living benefit, you can put in as much as you want to, so that, like my dad said, there's not like the IRS rule or limitation like there would be on a Roth. So if you wanted to put $100,000 a year into here, if you want to put in $10 million a year into here, you can do that. So there's not that same restriction. Up to, like human life value, which again is something that we'll tackle another time. Most of the time, people are limited by their budget, not by the ruling of what you can do with an insurance policy. Okay. Now, to get the tax protections, they're going to say, okay, if you want this to be tax protected, then you need to fund it a minimum of 7 years. You can fund it longer than that, but 7 years is the minimum. Okay. Now, with that, we're going to say, okay, what's the minimum amount of death benefit that I need in order to put in, and I'm going to say, I want to put in $10,000 per year into this policy. Now, a policy can be paid on a regular basis, whether it's monthly, quarterly, semi-annually, or annually. You can also do a lump sum right here. So there's multiple ways that you can contribute and put into a policy. Okay. Now we want to be able to have the right components here. So I'm going to tell it that I want this flexible protection rider. And I'm also going to say that I want to be able to add this other rider, which is called a paid up addition rider. And I'm going to say that I want majority of what we put in to go into this paid up addition rider. Now this paid up addition rider is basically going to go straight to cash value. Now I'm also going to tell it that I want to stop funding it at some point. Okay, IULs and ULs, those you can't really stop funding because then they kind of eat themselves up faster. Whole life policies, you can fund it for 7 years, you can fund it for 10, 15. You can fund it until you're 100 years and anywhere in between there. So I'm going to say that this person's 50 and his goal is to retire at around, 65, 67, kind of normal retirement age. So I'm going to just put it in this way. Now this $10,000 per year, the number that I'm using that because I want to show you what the percentages look like, which I'm going to run that here. Okay, so we want three things to be part of this. We want the whole life contract, which gives us cash value that we can use. We want a term insurance rider, because what's more expensive, term or whole life? We talked about that. Term insurance has a lower cost. So the IRS says, hey, in order to put this much in, you need this much death benefit. Well, do we need all of that death benefit to be in the most expensive bucket, which is whole life, or can we have some of it be term insurance, which is a lower cost? So by adding that rider, it allows us to be able to satisfy the IRS requirement definition of a life insurance contract, but it gives us a lesser premium, which allows more to go in that paid up addition category, which is exactly what we want, because that's going to go straight into cash value for us faster. It's kind of like the lighter fluid on cash value. Okay, so this 50-year-old, we said he wants to put in $10,000, okay? And the IRS says, okay, in order for you to put in 10,000, Mr. 50-year-old client with an okay health, not great health, not bad health, but okay, then we're going to say he needs $224,139 in death benefit to protect this 10,000 that we told it that we want to put in. Now this 10,000 just became our limit and our maximum that we can put into this contract. Okay, we just set that limit arbitrarily. Your number that you pick and your budget amount or whatever that you're wanting to do is going to be different than this number, okay? So it could be 5,000, it could be 10 million, whatever your number is, okay? These percentages are going to be similar though, so that's why we use this number. Now this 10,000, he has to have $224,139 in death benefit. So like I said, we want half of that to be whole life and half of it to be term insurance, so that we can have the advantage of growing cash value and also have the advantage of having lower cost of insurance with the term insurance rider. Now this term insurance rider is very, very different than other companies, by the way, and also different from a normal term insurance policy. This is a rider, so it's there because of the purpose of the tax benefit, and it's also there to help us to get our costs down lower so that we can have the policy itself grow faster. And so this is a rider we can pay on here until we're 100. Normal term insurance, you can't keep it till you're 100. This one you can because it's a rider and it's attached to a whole life policy. Okay, so this is the amount. Go ahead.
Let me just jump in here for a second. Would you look at that number? How much did we put into this? $10,000. Just hold that down for a second, Christy. So we're putting in $10,000. And if you go over to the face amount, over the 224, didn't we just increase your net worth by $224,000? Yes. What do banks do? They create wealth out of thin air. What did we just do? We just created $224,000 of death benefit. And most of you are thinking, well, but I don't get that. That goes to my family. How about if I show you how to spend that in retirement tax-free? Stay tuned. But that $224,000, I've just given you 22 times more than you gave the insurance company. They gave you an asset that's worth $224,000, and they did it out of thin air. This is part of Nelson Nash's genius, as he recognized that, wait a minute, banks create money out of thin air, don't they? Yes, they do. And Christy was saying that insurance companies and banks are the two largest and the most productive and the most profitable businesses on the planet. They both do the same thing. Not only are we going to create an asset that's worth $224,000, the insurance company is then going to count that as collateral to lend you their money. Let that sink in. It's ingenious. It really is. Go ahead, Christy.
Now, another thing on that note too, if you look up your bank, you can see what your bank holds in assets. Okay, probably, 20 years ago, 30 years ago, majority of the bank's assets might have been like real estate or might have been, like other liquid accounts. Over the years, and you can actually go back in time and see, like how much they had in assets in different years, you can go back in time and look at historicals. You'll see that the amount that they have in insurance is actually higher and higher and higher every year. And then the real estate is going less and less. So let that sink in. So if banks and insurance companies are the two biggest industries and they're the biggest money makers, maybe we want to take a page out of their book and understand why they're getting things like this. So understand that this is also referred to sometimes as a rich man's Roth. In other words, it allows you to be able to put money into here, and this is kind of where wealthy people and corporations tend to put their money. And so the rest of us are kind of catching up to this idea, but you'll see why in just a second here. Okay, so if we have 10,000 that goes in the first year, then we want to know, okay, where does it go? So we're going to focus on this first one here, this category column section here. So we've got the first, let me get my little thing here. Okay, so we've got this base contract premium right here is the whole life part of the contract. So the question should be, okay, how much am I paying for this death benefit right here? Okay, now again, this death benefit is going to benefit you, and it's also going to protect and be left for your beneficiaries. But like my dad said, we're going to show you how to use this death benefit and actually cash it out. So we've got 29% of whatever we're putting in this case, is going toward the base contract or giving us this amount of death benefit. Now, face amount and death benefit are the same thing. Now, when I said before that we want to be able to have term insurance that we're adding to it, now what's the difference in pricing between $2,962 and $1,229? Okay, now you understand why we want the term insurance amount to also be the same thing, because it gives us the same coverage that we need from an IRS standpoint, but it gives it to us at a lesser cost. Now, the insurance company only cares about these two ever being paid on this contract, by the way, because as far as they're concerned, this is for death benefit, so they don't really care if you do anything more than that. Now, if this was all you were doing, then you're basically just getting death benefit. You're not necessarily accumulating a lot of cash value. It's kind of just, you know, an efficient whole life policy. But we want most of what we put in to be in this third category, which is kind of the secret sauce, which is this paid up addition premium. Okay, the paid up addition premium, we want more of what we're going in to go in that category. So we've got 58% that's in paid up addition premium. Okay, and so those three numbers together are what makes up our 10,000 that we told it that we want to put in. Now, we've got two sections here. We've got guaranteed and we've got non-guaranteed. Guaranteed, because this is a whole life contract, they're saying, okay, we're going to guarantee that your money that you have here in the cash value is going to increase by 3% every single year. Okay, now this 3%, is that going to be taxed? No, because remember I said once it's in here, it's not going to be taxable. So 3% in a tax-free environment, what does that equal in your tax bracket? Well, it depends on your tax bracket. Are you in a 20% tax bracket, 24, 22, 32, 37, 43? I don't know what your tax bracket is. So you want to be able to look at the tax equivalent. If this was in a taxable environment, 3% doesn't sound as good because we're so used to getting raked over the coals in taxes that it doesn't sound great. Okay, now we're going to have guaranteed of 3%, which is what this is showing here. And then we're also going to have dividend, which is the profits that get divided up at the end of the year that are going to be added to our cash value. Now, the dividend is not guaranteed. Okay, the next question should be, well, what are the chances of that dividend getting paid then? Is that going to go down? Is it going to go up? What might that look like? Okay, so understand the dividend is the profitability of the company that gets divided among us policyholders. So that amount is not going to be the same every year. It's going to be different because the dividend changes on a year-to-year basis, or at least it can change on a year-to-year basis. Now, the dividend is where they're using funds in their general fund, and then they're lending out on big time horizons. So it's not market driven, it's economy driven. So when the interest rates are higher, what do you think happens to dividends? If they're lending out at a high rate, are the dividends going to be higher? Yep. Okay. If they're lending out at a lower rate, is the dividend going to be lower? Yep. So dividends follow interest rates, and they're usually about 3 to 5 years lag behind because they're doing longer time horizon loans. Okay. Now, when they're doing that, so this dividend that's showing here is the second lowest dividend that it's been in the last 30 years because it's still coming off of that low dividend environment that we were still coming out of, you know, a few years ago. And so this dividend is likely to be conservative because this is kind of assuming that we're going to go back down into like the 2 and 3% interest rate environment, which I don't particularly feel like that's likely to happen. So this should be a conservative number and should be a higher number going off of that premise. Does that make sense? So even though it's not guaranteed, you also want to ask how many years have they not paid a dividend and how old is this company? They're 179 years old and they did not pay a dividend the first year that they were in business. Okay, so you got to let that sink in. That means that they started in 1847 and they've paid a dividend every year from 1848 on. So the highly probability of them paying a dividend is going to continue when they've been through all the wars, they've been through the Great Depression, they've gone through all these recessions. So even though it's not a guaranteed amount, it is not likely that they would not ever pay a dividend again because they are in the profitability and they've got this down to a science. So this is going to use the assumption that the dividend is going to be the same in all of the future years as what it is now, which again is the second lowest dividend in the last 30 years. So that should be conservative. All right, with that, I'm going to kind of fast forward through this pretty quickly. So the first year we put 10,000 in and we've got 64% of it that's available in cash value. Now this is actually, that should be a higher number. Hang on. I'm going to actually change this for a second. I'm going to tweak this. Or should I? I can just go off of this. This is actually, I just realized that I needed to change something on here. This is usually going to be more like about 70%.
Mm-hmm.
This would probably be the equivalent of somebody who was like maybe 65 or 67. This is about what those numbers would be. Hang on, you guys, 1 second.
Christy, we're only got about 10 more minutes left.
I know. Okay.
So
Hang on, that's going to bug me though. I'm going to fix this.
Yeah.
I know what I
with you on
did.
that, Christy.
I put in the wrong year.
So while she's doing that, Shane put in the chat the banks the amount of money that the banks have in whole life insurance or in permanent insurance. So if you want to click on that later on, you can find your bank and you can see how much they have, and you'll find out they have more insurance than they own real estate by a long shot.
Okay. All right, you guys, this is a better number. I was like, that's way too low of a percentage. Sorry, I didn't catch that when I was putting that in. Okay, so whatever you're putting in, we've got about 73% in year one in cash value. So if we put in 10,000, we've got 7,300 that's cash value year one. Number one, is that a good investment? Is that a good return on your money? Nope, not yet, right? We're upside down. So that doesn't look good. That doesn't look like something I want to do. Now, where did the rest of the money go? Of the 10,000 that we put in, it went to death benefit. Okay, now the death benefit at the start is going to then increase because every time that we put new premium in, it's going to go to cash value and it's going to go to death benefit. Okay, cash value is what you're going to think of as your life insurance line of credit or your living benefit. So you have access to use 95% of whatever you have in cash value. And you have access to that 90 days after you start your policy. So if you put in 10,000 at the very beginning and then 30 days later, then you've got access to 95%. Okay. Now you've got death benefit that's going to go up and cash value that's going to go up. The second year, let's say we're going to put in another 10,000. And then this column here is showing what it's going to increase by just that year. So every year that we put in, it's going to get more efficient, meaning that the dollars that we're putting in, more of it is going to be showing up in cash value every year that we fund this. So when we were talking before about how this is not a great return on our money by losing some of it that we're not having access to, the only reason why this would make sense is if we're doing it and in the long run, it's actually going to come out ahead. And if you knew that you had an account that was going to lose 26.5% the first year, but then you knew that it was going to be increasing in profitability every year that you had it, would you continue to put into that account?
And think about putting your money into a 401k. If you put $10,000 into a 401k, how much do you have?
Mm-hmm.
You don't have access to any of it.
Yep, actually, good point. Okay, so this is showing year over year what it's increasing by based on the new premium you're putting into it. So by the third year, we're almost at what we would call positive cash flow point. By the fourth year, we are there, meaning that we've put in 10,000 and it's increasing by $10,710 that year. Now, this is your cumulative running total, which is going to get added to what was there the year before. So even though this year is positive cash flow that year, we're still overcoming the negative cash flow of the first 3 years. So we've got 36,000 in cash value here. Okay. Now it needs to be funded for a minimum of 7 years. So let's see what happens by the time we get there. So we also look for a second point, and those of you who might have policies like these, you want to look at what your own crossover point is, by the way, because that will tell you if it's an efficient policy that was designed for this, because chances are it was not. Okay, now if we've got 70,000 that we've put into it, and now in that 7th year we've got 72,000, we've now reached a crossover point, meaning everything we've put into it, now all of it is showing up in cash value. When that happens, we can stop funding the policy altogether. It will continue to grow, and it will maximize and get better and better every year that we have it. In this case, this guy's going to keep putting into it. Now, first of all, same thing. Is this a good return on our money? We put 70,000 in, we've got 72,000 that's here over a 7-year period. Is that a good return? No, I don't think so. Okay.
Great.
Now, the only reason why this would make sense is if it spends better than a 72,000 would somewhere else, which it absolutely does. So because of the death benefit and because of the design, this is more spendable than what it looks like the return is going to give us. Okay, so keep that in mind. I'm going to fast forward for the sake of time. I'm going to take us out 15 years. Okay, so he's 65 and now he put in his last 10,000 that he's planning on putting in, and we're going to turn this into income. Now that 10,000 that year almost doubled that year. So you see how every year you get a higher percentage of it going in. So it gets better and better every single year. So the first 3 years, we're taking a loss on what we have available to us. The 4th year, we've got a 7% increase. Then we've got a 15% increase, 20% increase, 27% increase. I don't care what kind of math you do. I like those numbers. I like that it's going to be compounding and increasing more and more every year that I put it in. Right here, we've got a 94% increase. So it's going up almost 100% more than what we put into it. And now we're going to stop funding it. And we're going to show you what it looks like to take income. So if I've put in 150,000 and now I've got cash value of 203,000, is that a better investment return? Okay, it's looking better. Now consider the fact that this is a tax-free return, so it's going to spend very different. You're not having to share some of your profits with the IRS on these, which also makes it more spendable in addition to the design. Okay, now I'm going to show you what it looks like to take income, because this is the best part. Okay, because if you look at how much you can spend on a taxable account and how much you're actually left with versus this is where this shines more than anything. Because can you do better on an accumulation account than what I just showed you? Absolutely.
Possibly.
Well, absolutely, possibly.
Possibly.
Yes.
Yes, absolutely possibly.
Absolutely possible. Okay, so it could do better, it could do worse, right? But how does it spend? Okay, so now I'm going to tell the computer to solve for me, and I'm going to say, okay, we want to start taking distributions. And we want to be able to, now that we've accumulated in this account, now we want to see how much can we suck out of this thing in living benefits. Now, this is always going to leave a death benefit, but in this case, we're prioritizing living benefit, in other words, spendability over death benefit. Okay, so we're telling the computer to solve for us, and we're going to take out from year 16, and I'm going to put through age what? Through age 95, let's say, okay, which is 30 years worth of income. Now, in this case, I'm saying, okay, we want 30 years worth of income because we're going to retire at 66 and we want to go through age 95. And we're asking the computer to solve for us, and we're saying we want the same amount of income every single year. So we're basically creating an account and telling it that we want to drain this account, and in cash value, we want to keep the tax benefits, and we want to come as close to $1 as the IRS is going to let us get by the time we're age 95 to take these living benefits out and still leave a death benefit for our family, but the priority being the living benefit that we're trying to take out. So the cash value is going to go down as we start taking income, and the death benefit is going to also go down because we're going to tell it to do that.
One thing too, we always illustrate taking an even distribution every year. You don't have to take the same amount every year.
Yeah, I was
Right?
going to
That's
say,
just an example.
Usually when I do this, I will also do it in a 3% increase so that you can see what that does with inflation, so that way you can have a better idea of how spendable that is. Okay, now we've got 11,281 that we're able to take out in income. Okay, so I want to let that sink in for a second. We only had 194,000 in the account here. Now, if this number was 20,000, these numbers would be doubled. If this was 30,000, this would be tripled. So that gives you an idea of what that looks like. Okay, so you can also, if you did half of this, then it would be half of this. Okay, so that's another reason why that $10,000 number is helpful. Now, this 11,281 that we're able to take out, I want you guys to get your calculator and take 11,281 and multiply that by 30 years. And somebody tell me what that number is. So we've put 150,000 into it. So remember, we always ask ourselves, how much did we put in and how much did we take out?
338,000. 338, 430.
Okay, so we're taking out 338,340 over that time frame. Is that a good return on our money that we put in?
Now, remember I said that I wanted you to go back up to what the original death benefit was, Christy? The original death benefit, actually, go up to the top of that page. Original death benefit was 238,000, and you're able to spend 338,000. So that extra $100,000 that you got to take out, you need to split that with us.
Finder's fee.
No. So I lied. I told you you're going to be able to take out 238. You're able to take out 338. But look down at the end of your life right there. Oh, well, Kirsty, go ahead. I'm getting ahead of myself. You're getting ahead of you.
Well, and really quickly on this. So from an IRS standpoint, how we're doing this, and this is set up this way. This is called a life insurance retirement plan. So this is not like pulling one over on the insurance company, by the way. They know this. This is what it's designed to do. Okay, so when you've put in 150,000, from an IRS standpoint, they say, well, let's take a withdrawal first against your basis or what you've put in. Once you've reached that point on a normal account, like let's say it was a brokerage account, then anything above what you've put in would be taxable, right? So wouldn't an insurance policy be the same? Is after we've reached our basis, then we have to pay tax? Okay, so once you've gotten to that point, we still have 165,000 in the policy. Okay, so do we want to pay tax on this gain or not pay tax on the gain?
No.
No, thank you. Let's not pay tax on the gain. So the death benefit is where that comes into play, because the insurance company says, guess what? You've got this death benefit over here. If you want to, why don't you let us give you a loan so that you can continue receiving the income that you want to receive? And this is a loan that you have no intention of ever paying back, because the insurance company already has this set up for you, that as this is accumulating in a loan, this is a loan I'm not having any intention to pay back. And so at some point, I'm going to pass away, right? So let's say that this guy passes away at 90. So this right here, this death benefit number that's going down because we told it to, this says net death benefit. So this is the amount that goes to your beneficiaries after this loan is already paid off for you. It happens automatically. The policy is set up and designed to do exactly that. Okay, so it's going to pay it off for you. Now, if you have a windfall and you say, well, but what if I want to pay off that loan? Then what? Well, then what do you think would happen to the rest of these years if you paid this loan off and you had an inheritance? Then all that does is it resets this whole thing all over again and gives you way more to spend for the remainder of your lifetime.
Now, if you took the time to explain this to your kids, maybe your kids could figure out where they could come up with $186,000. Pay off the loan, and guess where the money's going to, what would that do to the death benefit? It would pop it way back up again. And then where would the death benefit go? To your kids.
So this is also a little bit of long-term care planning, because where might this 186 come from? If you've got a property and then you need to go into a facility, where are you going to put the money that you just sold your house? Where are you going to put that? This gives you a place to put it and reset everything back up again. And again, it allows you to be able to have that as an option. In this scenario, this is planning on that never happening, and that you're going to actually let the death benefit pay off the loan here when you're 95, because that's when you're planning on passing away. Now, if you don't pass away, then the question is, okay, well, what happens to that loan and my income after 95? Well, this is a whole life policy, and so this death benefit is still going to stay in place. It's going to keep going down, but they're going to never require you to pay off this loan because we have a rider on here called an overloan protection rider, which says that this is going to stay in place even though the loan balance is going up and they're not giving you income that you can take anymore. We've got to have the cash value and the death benefit always stay in place so that that gets paid off regardless of if you live until you're 121, which is how long this goes for. So that death benefit is always designed to pay off the loan that you have there and still provide a death benefit to whoever your beneficiaries are at that point. So it's helpful to be able to understand that if this was in a taxable environment, what does this number need to be in a tax environment to give you 11,000 a year?
A lot more.
A lot more.
Okay. So remember when I was saying the rule of thumb, like if you're in a 20% tax bracket for every million, then you're able to spend 27,000. Okay, so this would have to probably be about 400,000 or 500,000 right around in there in order to give you this in spendable money if that's your tax bracket. So let that sink in for a second. Do we need this to be a massive number in order to give us the same benefit here? So you can either take the risk and have this be 400,000, or you can take this steady Eddie path and have the same thing with very little risk. Now, the other cool thing is, what about the use of this money along the way? Can you access this and use it and still have it be growing?
Mhm.
You can borrow against it, which means that the insurance company, let's say that you need to buy a car right here for 15,000 and you have cash value here and you say, well, what if I want to take a loan? The insurance company is going to say, you can use our money and we're going to let your money basically still be growing here and be earning dividend. So borrow our money. You can replenish and pay it back however fast or slow you want to. So then instead of somebody else making money off of you, you're able to then double dip. Because remember, are you an owner of this company? So when you're being charged an interest rate, do you get some of that back in dividend? Okay. So understand how that works, that on a 401k, when you borrow from the 401k, you're taking it out of rotation. On a policy, you're still allowing it to continue to compound and grow, even though you're taking it and you're using it to pay for a car, and then you're going to replenish it. And when you replenish it, if you take this out and then you decide whatever your payment plan is, the insurance company doesn't tell you your payment plan, by the way. You're going to decide what that is and how fast or slow you want to replenish your line of credit again. The faster that you pay it back, the faster you have the availability to use for the next opportunity or the next expense or the next whatever comes up. Now, this is not even using the policy. This is just letting it sit here. But just know that you can use it. And when you do, you want to put it back so that you can, again, use it again in retirement, which is something very unique and different that you can't do with any other policy type. So in addition to this giving you more spendable money, it also gives you liquidity and use along the way between now and retirement anyway. And so you're able to double dip on those same dollars. They call it an and asset for that reason.
Christy, go down to the 16th year just for a second here. So look at this, you guys. We're taking out $11,281 of income tax-free, but look what your cash value does. Your cash value goes from 194 the year before to 193, which means it dropped by only 1284. In other words, you took out $11,000 and your cash value only went down by $1,200. How does that happen? Because once, as Christy said, we need to get past that 7 year. Once you've had at least the policy for at least 7 years, you can't kill this beast. What I mean is it'll continue to grow. Reminds me of the Hotel California song, the stealing, you can't kill the beast. You can't stop it. Now you can screw it up by taking loans and not repaying them.
Yeah.
And that's not an honest banker. You're cheating yourself when you do that. But that
Well, it's no
11,000,
different than if you did like a home equity loan on your home and then never replenished it. So
Right.
think of it the same way. This is not like free money. You're basically having use of it, but you want to put it back. If you don't put it back, it will reduce the cash that you're able to take out of it tax-free because you robbed from your account. You didn't borrow from it. So keep in mind that you have the option to do that and have it continue to compound and grow. So
Deanna, do you have a question?
I do. So a while back you had said, because you talked about doing a like kind of a long-term care plan, like if you had a windfall or something, and that you like if you needed to sell a property that you're in to go into a care facility. Aren't you limited though by the amount that you put in because it can't be greater than the face value? So I mean, houses in California here are like in the $1 million for nothing, for a big closet, pretty much.
right. Well, and you're right. Like it can only handle there's two ways to get money into a policy. One is through premium that you're putting in. The other is loan repayment. And so in that case, Deanna, you're exactly right. Like if you're 90 right here, and let's say you sell a property and your property was 500,000, then you
Mhm.
can only put 186 into here because you can't pay more than the loan balance that's here. So you'd
Right.
have to still find something to do with the rest of the balance. Absolutely. So you are
Okay.
limited by whatever the loan balance is. Yeah.
Okay, that's all. I just wanted to make sure I was still
Mhm.
thinking properly.
Yep. So again, this does not need to give you a fantastic rate of return to be able to give you more spendable money. And that's really the whole point of this discussion, is understanding that these numbers are going to be different for each person, you know? So this amount here, like being 6,200, you know, it's going to vary by each person, but it's never usually worse than this. So this is kind of like a worst case scenario. And I don't know why that number changed on me, actually.
The other thing, Christy, right there, when that $11,000, the first thing that the $11,281, which you get tax free, the first thing I did was divide it by 12, which is like $940.88,
Mhm.
which isn't that much, but is tax free each month, and that would take care of whatever insurance that you have, your insurance premium that you have to. That's the way I'm looking at it, because I'm like going, wow, $11,000 a year. I mean, when you multiply it by 30 years, yes, it's not a lot for the month, but it's tax free, and it doesn't count as income, so you could use it to pay your medical insurance when you're older.
Yeah.
But I didn't think about it at first, multiplying it by 30 years, like you guys said. I'm like, how come I just picked the worst way to think about it? You
Yeah.
know,
Well, and you're right. So
it's
this
still
is,
good.
yeah, this is on a $10,000 number. Now, keep in mind, how much should somebody be saving? Okay, if you're in your 20s, then saving 10% of your income is fine as long as you're doing it consistently. The longer that you wait to start saving, or the less that you've been saving that and you're making up for lost time, it might be 15, 20, 30%. Okay, I talked to somebody earlier this morning, and she needs to put 30% of her income aside because she has robbed from herself for a long time and she has a ton of debt. Okay, so it's all relative based on your income, based on what you're wanting to live off of. Okay, so this $10,000 number would be assuming that somebody was, you know, in their 20s and they made $100,000 a year, then this might be sufficient. But they're also not only saving for 15 years, they're saving for a longer time frame. So this would be, you know, not sufficient for somebody as far as savings goes. So this would either be a supplemental plan for somebody likely, like what you're saying, Deanna, or it would be somebody who has very low income, like, or much lower income, in order for this to make sense for somebody, because that's not going to be replacing anybody's income. Now,
No.
if you are making $100,000 a year and you need to put 20% aside, then these numbers are double. And so then you've got, you know, $22,000 a year that it's giving you an income. And that again is assuming that the person has been a good saver and then they're still doing 20%, and then that might be a secondary amount. So keep
But
in
go ahead.
second. So keep in mind that Social Security was never intended to replace anybody's income. So if you are in a lower income bracket, then it might give you up to maybe 30 to 33% of income replacement. The rest of it needs to come from you. Okay. And if you're not saving what you're supposed to be saving, you're going to need to make up for lost time. And you guys don't prioritize your debts over your future. So you need to save first and then pay your debt second. And if you can't pay your debt second, then you have too much debt and you need to sell some things and you need to relook at your budget and make room for that, because you need to be saving or you will be making up for lost time and you'll be not retiring or you're semi-retiring. And so this is a good retirement plan, but this is likely somebody who has maybe like 50 or 60,000 in income, and then they might have $30,000 a year or 35 that's coming from Social Security, and then this is supplemental, and they might have a retirement in 401k.
But
Okay, so
if a young person starts this way with a small amount like this, and they get used to the habit doing the habit of doing this, then when their income comes up, they can buy another policy and then use and borrow from this policy to pay a higher paid up premiums, and then that's how this stuff works to build up on each other. I'm gonna think about that myself.
And either way, so if you think about that, you're really trying to compound things as much as you can. So somebody starting younger, so those of you who are feeling like, okay, I've got a late start in this, if you know that you only have to accumulate 60% of the money that you normally would have to have, that takes the pressure off of you a little bit, doesn't it? So if you were trying to do this the traditional route, then the amount of money that you need to amass is very high. And so by having this in your bucket, regardless of if it's the front runner or the, tandem or supplemental or whatever, either way, it takes the pressure off of how much you need to save, because you're not losing any leakage to taxes. And then you also have the use of the funds to be able to use. And so it
Christy?
helps you to get to retirement faster. And you only need about 60% of the amount that if it was in a 401k or some tax deferred account.
Christy, real quickly, do me a favor. And right now she's taking this money out at age 66.
Mhm.
What if change that to 70, or change it to 71, just for giggles here. So remember that 11, what was it? What was the number? 1181?
11,281.
Okay, just remember 11,281. What if you had money in a 401k and you drained that first and let this policy cook for another 5 years? What would that do for you? You have to remember that this is the time value of money that we were never taught. Money makes money based on time, and this is why you can't do math without including time. When people do math without including the time element, it's always wrong. But look at that. That increases that by $5,000. All you're doing is waiting for 5 years because it's cooking a little longer. Okay. So, I mean, how you get money out of the policy, it depends on what else you got that's going on. Now we're talking about income planning or retirement income planning, which is you've reached to the top of the mountain, now you're coming down. And the skills that you use to get you to the top of the mountain are not necessarily the skills you need going down. And this is a classic example of what you're seeing there. So guys, thank you very much for your time today. Anything else you want to add to that, Christy, before we wrap up?
Nope. I was going to say, when we go through this with you individually, just know that these numbers are going to be slightly different. By the way, when I changed that, it popped it back up to this 73%. So somehow in there, I messed up my algorithm. But just know that if you are in your 60s, this might not be 73%. It might be 70%. If you're in your 20s, this might be 76%. So it's not drastically different one way or the other. And so sometimes people feel like it's going to be more drastic and they say, well, what if I were to put this on my kids? It usually makes sense to put it on you unless you were really not insurable, but it's not going to be a huge difference because we're not solving for death benefit. We're saying what's the least amount that we need to have in death benefit to cover the amount that we tell it that we want to put into it. So when you understand that, then it helps to be able to see that you're going to have a similar growth on your own policy, even if you feel like that you're getting a late start. So it does not make as much of a drastic difference as what people think. The most important thing is that saving money as early as you can to let it compound for as long as possible. If you're trying to pay off your debts first and then start saving, you're going to be having to accumulate more to make up for that lost time of not having that compounding income be able to be accumulating for you. So the best time to start is now. And also the next best thing is to look at your budget and see where you can cut back on things, because you can actually give yourself a better rate of return by lowering your budget than by trying to chase the market accounts. So it's the best strategy to be able to be, conservative, and then also sometimes take advantage of the market too. So if you've got a 401k and you've got this, then this person having a 401k is probably going to give them more income. But also, what does that do to your tax bracket if you've got 16,000 that is not counting on your taxable income? That might actually reduce your tax bracket. So does that save you money in retirement too? Absolutely. So those are just some things to consider, and that's what we do when we do your personalized design and everything else. But hopefully you guys found this beneficial and it was a good refresher for those of you who have heard it before. Now,